Hello, everybody. Welcome to this week's Fireside Chat. My name is Coburn Sheppick. I'm the CEO and founder of Dovetail Investment Group. In today's video, we're going to be discussing how inflation impacts commercial real estate. So I'm super excited for this conversation. There's obviously a lot going on in the world, and we're happy to be spitting the fire today. So let's dive right into our topic of how inflation impacts commercial real estate. So some of the topics we're going to be discussing today, I want to do a brief introduction on Dovetail, then we'll cover our state of the market, then we'll dive into our topic of this week, which is how inflation impacts commercial real estate. And then at the end here, I've got an exclusive invite for that I'm excited to share with you. And before we begin, I want to make it clear that we're not your financial advisors. We're taking the data that we all have access to and sharing our perspective on how this might intersect with the market. So a little bit about Dovetail. Dovetail is a private investment firm that makes principal investments using its own capital and capital raised from outside sophisticated investors, primarily into commercial real estate assets. We aligned with seasoned operating partners to strategically place capital and leverage our expertise to structure the risk away from ourselves and our investors. Who we work with established and evolved investors who are attracted to investing alongside some of the world's best real estate operators and sponsors to insulate their wealth and reputation in an uncertain world. So I want to share a little bit about our typical investment profile. We work with and align with best-in-class operators that operate across all segments of the commercial real estate market. We have the types of operators that we work with position themselves directly to a certain type of investment, whether it's development, multifamily, stabilized assets, and industrial. We're locating the best of the best operators to create a diversified profile for our investor consortium. We are focused on growth markets, core plus, core units, class A type of projects. And as the market is moving, now we're changing our perspective to focus on opportunistic and the potential distress and special situations that we see coming in the nearest future. We're a little bit biased towards industrial right now and single tenant or retail property, as capital flows have driven asset types like multifamily through the roof. And so likely we'll see some of that move over to these more stabilized and more creditworthy tenants. Typical hold time for us is 5 to 7 years, which is pretty common in this industry. And so that's a little bit about what we're focused on. Now, I want to dive right into our topic to talk about the market, and some of the data that we'll show is pretty chilling, if you would. So let's start with inflation, which is obviously the topic of the discussion today. We'll save how that intersects with the real estate market later on. But just to recap where inflation sits right now, inflation is at a 40-year high. It's nearing 9%, the CPI is. And true inflation, which is some of the items that are excluded from CPI, would put us at potentially double that. And so we're at a very scary time right now. And what has happened is the question. And what happened is the amount of money, of dollars that were printed over the course of the pandemic, stimulus. We all got a paycheck in our pocket, whether we asked for it or not. And businesses collected millions of dollars during this time to keep their businesses running. And so what that does, obviously, is devalue the dollar. And at the same time, all that money had to be allocated somewhere. A lot of it went into the stock market. That's why we saw the stock market blow up. And a lot of it went into real estate. And that's partially what we're going to get into today. So a very scary fact is that, and this number is just a basis, more than 20% of all the dollars in circulation were printed over the last 3 years. And so you'll see on this chart where we are, which is the last measurement of where the blue line here on the top is all of the items, and the red line is all the items less food and energy. So as we know, gas prices went through the roof, and they've kind of tapered off. We don't know how long that'll last, but you can see that the energy was a big factor in there, and so it's a very interesting time, and it's actually kind of scary. We've got potentially a major affordability crisis ahead of us, which we'll get into later. Interest rates are the topic specifically related to commercial real estate. Obviously, it affects all industries and businesses, but obviously the way that people buy real estate with leverage, mortgages, commercial mortgages, with rates that were historically low for the past handful of years. If you look on the chart on the right from Fred data here, we've been down to nearly zero, under 3%. We were at not very long ago, and we were there since, well, we jumped up a little bit, but we were there for almost 10 years. And that incentivized growth, it incentivized building, it incentivized investing. And so people have been all hyped up on free money for a lot of years now. And when interest rates kick up a few basis points or a few points, it freaks people out. And if you're looking at the chart here, we're still at historically low levels, but the speed in which rates are rising is it's the largest jump in nearly 30 years. And so we won't get totally into it today, but how interest rates affect commercial real estate obviously affects borrowing costs, affects construction costs, which affects supply and demand. And in today's environment, in today's economy, because of the levels of value, alongside utilizing short-term debt, like bridge debt, for example, and if there's short-term business plans where there's a need of a refinance, for example, in a short period of time, the speed in which rates are increasing could potentially put a lot of bad things to come, a lot of distress to come, because when people have to refinance and values aren't where they rates are not where they need to be in order to cover their debt service, you know what happens in that case. So what we're seeing already is pricing adjustments for the interest rates that are climbing, because values are so high and cap rates have been compressed for a very long time now. The going in cap rate in today's environment is, in a lot of cases, depending on the asset class and location, obviously, is higher than the going in cap rate, which is negative leverage, which means more risk and potentially distress in a lot of circumstances. So interest rates are putting upward pressure on cap rates. We're already seeing it, an expansion there, repricing adjustments, and it's for sure, as we just mentioned, putting major pressure on year one returns and even year two returns, depending on the project type. And lastly, we have a major risk of a recession. And are we in a recession? I would say yes. Some people would say no. The NBER is the one who calls recessions, and they have not yet called it. Historically, recession is measured by two consecutive quarters of declining GDP, and we've already surpassed that. We're going into the third quarter here shortly, and I wouldn't be surprised, obviously, if we have another series of declining GDP. So what type of a recession will we see? Will we see one? That's all unknown, but we have a lot of things on the table here that we have at hand. Number one, inflation is through the roof. Two, interest rates are rapidly climbing. To combat inflation, we have declining GDP. We have a hot housing market that, and we're not talking about the housing market, but we have a housing market that is becoming obviously unaffordable, and that is on a curve right now. We've got war in Ukraine and potentially global crisis, and we've got policy that is going to print more money over the course of the next several years. And what that does is add to the inflation potentially, even though the policy is targeted to help that inflation. But anytime money is being printed, this is what happens. And now, as of recently, we've seen unemployment spike up a little bit, not much at all to be worrisome, but we're seeing it in the headlines already of layoffs. All the big companies are having layoffs now. And so what this does, if you look at the mortgage industry, for example, right now, which is a massive industry, and when interest rates rise, housing market's hot, people who are making big commissions selling mortgages are going to have a very, very rude awakening. And so what does this all mean? We look at the data, and the data numbers do not lie, obviously, but this is a very uncertain time, to say the least. Now, this chart that we're looking at on the screen is basically what's showing a negative yield curve. And if you look at the chart, what happens when there's negative yield? Back to 1980, every single time we've hit negative yield, we've followed with a recession, which is in the gray area on the chart. Does that mean we're going to have a recession? Not necessarily, but based on historical data, that is what has happened. Now, take this information and do what it with you, take it with a grain of salt, because the times are also changing, and we have new policy, a potential changing world order, and massive amounts of printing, unlike we've ever seen in history of money. We've got digital currencies now. And so it is, to put it plain and simple, it's unknown. Okay, let's dive into our subject here, which is how inflation impacts commercial real estate. As we've mentioned a few times during this conversation so far, inflation is the increase in the cost of goods and services. And so what does that immediately disrupt? It disrupts development costs, because the cost of material, the cost of labor, the cost of land, right? All these materials and everything goes up. And what happens when things go up? Then rents have to go up, because, or else there'd be no returns there. So it's a constant battle, because we have a supply and demand issue. And so when development costs go up, that means developers potentially hold back. And especially when interest rates are climbing to combat inflation, developers also tend to hold back because of the fear that there could be even higher rates, which will eat away their profits and create a potential challenge in refinancing and securing long-term debt. And so we're already seeing developers slow down, after the longest period of expansion, and especially over the last, several years, whereas supply and demand got shut off because of the pandemic. So we are playing catch up from the already previous longest expansion period we've had pretty much in modern history. And so developers are pulling back. And at the same time, there is still an imbalance of housing, for example. And so this is creating massive demand for increased rents, and which causes massive affordability issues. So the rate at which housing costs, for example, versus incomes, or for businesses, the production costs and material costs versus the sales, this affects all industries. And obviously, because of the amount of money that's pumped into markets and pumped into real estate, values are then disrupted and skyrocketed. We've seen multifamily, for example, and industrial, for example, go through the roof. And in some cases, I'm in Phoenix, and multifamily rents have increased 25-30% in some cases. So how long is this truly sustainable? And how long will it take for people to not be able to pay rent? And how long can gas stay down in this short-term period before it spikes back up? How long can people afford for a $7 gallon of gas? Not very long. And so inflation is good for real estate owners, but the problem is what comes with inflation, which is rate increases, which makes it hard for sellers and developers. And so also with inflation, because of the cost of expenses rising, there's a more desire for yield and a fight for yield. And so think of this as that's partially why we've seen some of these asset classes spike and skyrocket, because knowing that real estate and rents climb during this inflation period, investors want to grab that opportunity because that's where the yield is. But because there's a massive seek for yield in these types of asset classes, values skyrocket. And now we're at a time where yield in those same asset classes are potentially going to be hard to get, and also be potentially risky, because how long can these prices stay elevated? Will they stay elevated? They could stay elevated, but in a lot of cases, and if we look at history, we know that likely there will be a price correction. We're already seeing that happen. To what extent, we don't know. So inflation is a great thing if you bought a property, over 5 years ago. If you bought a property in the last 3 years or 18 months, depending on what type of debt, it's all in the debt, things can get potentially ugly, and depending on how, the business strategy is. But overall, how it affects real estate in general, or affects commercial real estate in general, does vary. Certain asset classes like multifamily, the reason why we've seen values skyrocket so much in some part is because of the short-term leases. And so because there's demand's high, because there's lack of supply, because of certain growth markets where in-migration was so high, like in my market, like Phoenix, or like in Texas, or like in Florida, where there's a supply constraint because of the migration that went into those areas of our nation. There's a massive renter pool, and because the amount of turnover is how quick those units turn over, every 12 months, for example, that allows for operators to increase rents that often, unlike other asset classes like industrial, which is done also very well, or triple net leases. These are longer term leases, and so it takes more time to increase the rents in those cases. Although they're stabilized, those operators don't have the ability to move rents like they would in some other asset types, like multifamily, like storage, for example. But aside from being able to increase rents in those shorter term type asset classes like self-storage, and multifamily in particular, multifamily has a heavy operational cost. And because of inflation, because materials and labor, their expenses are rising potentially just as much. Unlike a more stabilized long-term, a more stabilized asset type like industrial, for example, there's not much day-to-day expenses. All right, it's a tenant, it's a building, long-term lease, tenant's responsible, and so their expenses are much more controlled in this type of environment. And what that means, what's better or worse? Well, it depends on the basis, depends on when you bought, depends on the debt, depends on the outlook of that business strategy. And so there's not one that's better than the other, but understanding those two scenarios and how they intertwine is key to this. So in a nutshell, values are disrupted, expenses are disrupted, and also, we're in a very interesting market because of the amount of migration out of areas like New York or San Francisco or California to the Sun Belt states, for example. So we'll see what happens, and that's all we can do. And we have to prepare for what's to come by looking at the data that we've been talking about today, and looking at historical periods of inflation, of high inflation. So that's it for our subject today. I hope this video helped you grasp a little bit of the state of the market and how inflation is intersecting with commercial real estate and what's potentially to come. So just to recap shortly, or just to add to that for 1 second, knowing where we're at, and by looking at this data, knowing the potential of what could happen, which is distress. Do we know when? Do we know how that might look? No, but are we going to play off being in fear and living in fear? No, but what we all should be doing is understanding the facts, understanding what has happened in history, and preparing for potentially what's to come. We all know that some of the best opportunities come when there's a sell-off, become when there's distress. Many people capitalize on hurt markets, and that's unfortunately the way that the world turns. And so what I'm speaking to you and speaking to our team is to understand the data, and we have to prepare ourselves for potentially what's to come. And so lastly here, I want to share with you that we are preparing ourselves, and we want to, we're not acting right now. We're staying dry. We're focused on the opportunistic and potential distress that is going to come. And so I want to invite you to join our waiting list. You can find us at dovetailig.com, or you can email us at at dovetailig.com. We are keeping a very close look at the market and how things are moving. It's very uncertain. Timing is unknown, but we're already seeing things change. We're already seeing repricing adjustments. We're already seeing cap rates start to expand. Is it a buyer's market? No, it's not yet. And so there are certain areas of the country and growth markets that'll continue to do very well, and other asset classes that have been avoided in markets that have been kind of pushed to the side over the last few years. There's going to be presented some really unique opportunities. So I want to invite you to join our waiting list, or you can join our investor group. This is not a solicit by any means. This is an ability for us to keep in touch and share what we are looking at. And if you're interested, we can set up a brief call to build a qualified relationship and help show you what's to come in the future. So thank you so much for your time today. My name is Coburn Sheppick. I'll see you next week.